Don't leave yet. This is not a video about getting rich. This is about something quieter, something heavier. Across America, millions of people wake up every morning with the same thought, even if they don't say it out loud. If something goes wrong, I'm not ready. Prices are higher, savings are thinner, jobs feel less certain, and here's the truth no one wants to face. Most Americans are not ready for what's coming to their money. Not because they're careless, not because they failed, but because the ground has been shifting beneath them for years. There is a word that defines the current financial state of America, not collapse, not recession. The word is fragility. On paper, the economy looks functional. People are working. Paychecks are coming in. But underneath, the foundation is thin. Across the United States, a majority of adults say money is their number one source of stress. Not health, not relationships, money. Surveys conducted nationwide show that more than half of Americans report feeling more stressed about money now than they did at the start of 2025. Many say their stress has become constant, not occasional. Younger adults in middle-income households report the sharpest increase. This is not panic. This is chronic anxiety, the kind that doesn't scream. It hums in the background. Ask people why they're stressed and the answers repeat. Not luxuries, necessities, rent and housing costs, groceries, utilities, transportation, insurance. Across America, housing consumes a larger share of income than it did just a few years ago. Grocery bills have risen far faster than wages. Even households earning decent salaries say their money disappears faster than expected. People aren't spending wildly, they're surviving expensively. Now comes one of the most alarming indicators. A large share of Americans say they do not have enough savings to cover an unexpected bill. We're not talking about a crisis. We're talking about a car repair, a medical bill, a few weeks without work. Nationally, some millions of Americans say they could not cover an emergency expense without borrowing. Many report having less than a few weeks of savings. A significant portion say they have no savings at all. This means one event can change everything. That is not stability, that is exposure. For a long time, paycheck to paycheck was associated with poverty. That has changed. Today, Today, a large percentage of Americans earning middle income say they live paycheck to paycheck. Many households making over $70,000 a year report having little or no financial cushion. Raises are often absorbed immediately by higher costs. Income exists, margin does not. And without margin, people can't prepare. They can only react. Another shift is happening quietly. People are working, but they don't feel safe. Across the country, workers report increased fear of layoffs. Many believe their job could disappear within months. Contract work and temporary roles are replacing long-term security. Even among full-time employees, there is a shared understanding. This job feels conditional, and conditional income creates constant fear. Then there is the future people avoid thinking about. Retirement. A large portion of Americans say they are not on track for retirement. They have saved far less than they believe they will need, or that they expect to work longer than previous generations. For many, retirement is no longer a plan, it's a question mark. Or worse, a hope. What this really means. Put all of this together. Rising costs, and you get a population that is functioning but not prepared. People are not failing, they are overloaded. They are carrying rising inflation, debt, stress, uncertainty. At the same time, this is not an accident, and it didn't happen overnight. What you're seeing today is not a sudden breakdown. It's the result of decades of changes that reshaped how Americans earn, save, and survive. To understand what's coming next, we need to look backward, because history explains why this feels familiar. In part 2, we'll look at how America went from financial confidence to permanent financial anxiety.
There was a time when money felt predictable. Not easy, not perfect, but stable. For much of the mid-20th century, the American economy was built around a simple promise. If you worked hard, you could live decently, save something, and retire with dignity. One income could support a family. Housing was affordable relative to wages. College did not require lifelong debt. Healthcare costs, while imperfect, were not financially ruinous for most families. Most importantly, wages rose alongside productivity. When the economy grew, workers felt it. This created something rare in history, a broad middle class with margin. Margin to save, margin to plan, margin to recover from setbacks. That margin is what protected people. But this system did not disappear suddenly. It began to change quietly in the late 1970s. Several shifts happened at once. Globalization accelerated. Manufacturing jobs declined. Global globalization accelerated. Financial markets gained influence. Productivity kept rising, but wages slowed, then stalled. Over time, a gap opened. Companies produced more while workers earned proportionally less. To most people, this wasn't obvious at first, because something filled the gap.
Instead of higher pay, Americans were given access to credit cards, auto loans, student loans, mortgages. Debt became the substitute for income growth. You couldn't earn more, you could borrow. For a while it worked, living standards stayed afloat, consumption continued. The illusion of progress held, but debt does something dangerous. It pulls future income into the present, and when the future arrives, it's already spent. Over time, behaviors that once signaled trouble became normal. Credit card balances stopped being alarming. Student loans stopped being temporary. Multiple jobs became common. Families adjusted quietly. 2 incomes instead of 1. Less savings, more risk. People didn't complain. They adapted. That adaptation masked a deeper problem. The system was becoming less forgiving. Mistakes mattered more. Interruptions cost more. Recovery took longer. Margins shrank. Every system reveals its weaknesses during stress. Economic shocks did that. Recessions showed how quickly jobs could vanish, how thin savings really were, how fast debt could spiral. Each crisis followed a familiar pattern. People absorbed the pain, institutions stabilized, lessons were promised, but the underlying structure remained, and after each shock, Americans returned to a system that required more borrowing, more personal responsibility for systemic risk. The pressure never fully reset. It accumulated. By the early 2000s, the expectation had shifted. Security was no longer guaranteed. It was managed. Individuals were told, save for your own retirement, manage your own risk, invest wisely, plan perfectly. But planning assumed stability, and stability was fading. Healthcare costs rose faster than wages. Education costs exploded. Housing became speculative. People were expected to navigate complexity with fewer buffers than previous generations had. History matters because it explains something critical. What feels like personal failure today is often structural change playing out slowly. Americans didn't suddenly become irresponsible. They entered a system that rewards efficiency over resilience, shifts risk downward, punishes mistakes more harshly. Financial readiness declined not because people stopped trying, but because the rules changed faster than expectations. So when people today say, I don't feel prepared, they're not imagining it. They were raised for one economic reality and are living in another. In part 3, we'll look at how rising costs, especially housing, food, and healthcare, finished what history started. Because prices didn't just rise, they locked people into fragility. There was a moment when people stopped arguing about economics and started talking about survival, not in dramatic terms, in quiet ones. I don't know how much longer this is sustainable. We're cutting things we never thought we'd cut. I make more than before, but I feel poorer. This wasn't a recession headline. It was a daily experience. Housing has always been the largest expense for most Americans, but something changed. Across the country, rent increased far faster than wages. Home prices rose beyond the reach of first-time buyers. Even modest homes required historically high monthly payments. For renters, a growing share of income goes to housing. Moving no longer guarantees savings. Rent increases arrive with little warning. For homeowners, high interest rates locked many out of buying. Property taxes and insurance rose sharply. Housing stopped being a foundation. It became a constraint. People noticed groceries immediately because food is unavoidable. Across America, grocery prices rose rapidly in a short period. Staples like eggs, meat, dairy, and produce saw double-digit increases. Families changed buying habits not by preference, but necessity. People began buying cheaper brands, skipping items, rubidisat, even immediato bun. It's not one big increase, it's everything, a little at a time. You don't notice until your total is suddenly $50 higher. Food inflation didn't just raise bills, it changed routines. Some costs don't scream, they whisper. Utilities rose quietly, electricity, heating, water. Insurance followed, auto insurance premiums climbed. Home insurance surged in many regions. Health insurance deductibles increased. These costs don't feel dramatic individually. Together they erode breathing room. People didn't budget for them, they absorbed them. Healthcare is where cost of living becomes fear. Across the U.S., medical bills remain a leading cause of financial stress. Even insured Americans report avoiding care due to cost. Deductibles and out-of-pocket expenses strain savings. Testimony: middle-aged worker. I'm insured, but I still check my bank account before scheduling appointments. Healthcare isn't just expensive, it's unpredictable, and unpredictability destroys preparedness. Repairs cost more. Insurance followed. Public transportation options remained limited in many regions. This meant rum ace no, higher monthly payments, rum ace less. Less flexibility, more dependence on steady income. A breakdown became a crisis. Here's the core issue. Wages did rise, but not enough. Across the country, pro increases lagged behind essential costs. Raises were absorbed by rent, food, and insurance. Earning more didn't mean getting ahead. This created a dangerous illusion. People appeared stable but had no margin. Once costs rise faster than income, something happens. People can't adjust easily. They are locked in to their housing, to their location, to their job. Changing jobs becomes risky. Moving becomes expensive. Taking time off becomes impossible. This is not flexibility. This is financial confinement. Preparedness requires slack, savings, options, time. The rising cost of living consumed all three. People didn't fail to prepare. Preparation was priced out of reach. When everything costs more, planning becomes a luxury. By the time Americans realized how tight things had become, their options were already limited. And that's when many turned to the only tool left, debt. In part 4, we'll look at how borrowing shifted from convenience to necessity to trap. Debt was not always dangerous. At one point, it was practical, a bridge, a tool, a short-term solution. You borrow to buy a home, get an education, handle an emergency, then you paid it back, but something shifted. Debt stopped being occasional. It became permanent. Credit cards were designed for convenience. They became instruments of survival. Across America, credit card balances climbed steadily. Interest rates reached levels unseen in decades. Minimum payments increased even as balances grew. People didn't use credit to splurge. They used it to buy groceries, pay utilities, cover medical bills. Testimony. Service worker, South, I tell myself I'll catch up next month, but next month costs more than this one. That cycle is not accidental, it's structural. Student loans were sold as investment. An investment in opportunity, in mobility, in the future. But for many Americans, they became a decades-long obligation, a barrier to saving, a delay to adulthood milestones. Millions entered the workforce already behind, not because they failed, but because education was financed through deferred pressure that never stopped accumulating. Cars are not luxury in most of America. They are access to work, to food, to life. But vehicles became more expensive, loans grew longer, interest increased. People financed transportation the way they once financed homes. That's not progress. That's necessity turning into obligation. A new form of debt entered quietly, smaller, faster, less visible. Buy now, pay later. It didn't feel like debt. That was the point. But fragmentation doesn't reduce pressure, it hides it. Many households juggle chafisology, credit cards, installment plans, personal loans. None feel overwhelming alone. Together they are suffocating. Interest is where debt becomes a trap. High interest rates mean payments go mostly to servicing debt. Ronix shrinks slowly. Ronix relief feels distant. People don't escape debt, they maintain it. Month after month, year after year, and maintenance consumes margin. Debt changes behavior. People stop planning long term. They avoid risk. They accept conditions they shouldn't. Testimony of an office worker. I didn't leave a job I hated because I couldn't risk missing a paycheck. Debt doesn't just limit finances, it limits choices, and limited choices reduce readiness. Preparedness requires savings, flexibility disappears. Time is sold forward, people aren't irresponsible, they are leveraged. But survival is not stability, and debt cannot absorb shocks forever. In part 5, we'll look at what happens when income itself becomes uncertain through layoffs, job instability, and a changing labor market. For a long time, Americans believed one thing above all: as long as I have a job, I'm okay. That belief no longer holds. Today, employment exists, but security does not. People are working. Paychecks arrive, but confidence is gone. Layoffs used to be dramatic. Factories closing. Headlines, public crises. Now they arrive quietly. An email, a calendar invite, a meeting that lasts 5 minutes. Across industries, severance periods are shorter. Rehiring takes longer. Testimony of a former manager. One day I was planning next quarter. The next day I was locked out of my work account. The speed matters because speed eliminates preparation. Even for those still employed, work feels different. Contracts instead of careers. Performance reviews instead of stability.
productivity metrics instead of trust. Many workers report fear of being replaced, pressure to do more with less, constant evaluation. Employment became conditional permission to survive, not a foundation. More Americans now work multiple jobs, not to get ahead, to stay afloat. Gig work fills gaps but creates volatility. Income fluctuates. Benefits disappear. Planning becomes impossible. Testimony gig worker. I never know what next month looks like. I just know I can't stop. Movement replaces stability, but movement is exhausting. Wages do rise on paper, but reality absorbs them immediately. Raises are consumed by rent increases, insurance hikes, food costs, debt payments. Workers feel trapped in place. I make more than before, but I'm not moving forward. Income exists, progress does not.
A new uncertainty entered quietly. Automation, algorithms, artificial intelligence. Jobs are not disappearing loudly, they're being optimized away. Not because people are bad, but because machines are cheaper, faster, and tireless. This affects office work, customer service, creative roles, analysis jobs. For the first time, many Americans feel my skill may expire. That fear changes behavior. When income feels fragile, people adapt. They avoid job changes, accept worse conditions, delay medical care, postpone family decisions. Risk becomes unacceptable, even when staying is harmful. Testimony, healthcare worker. I stayed because uncertainty felt worse than burnout. Fear becomes a management tool. Preparedness assumes continuity, regular income, predictable schedules, time to adjust. Instability removes all three. People cannot save consistently. They cannot plan long term. They cannot absorb shocks. They operate in defensive mode. Combine.
Financial systems do not run on money alone. They run on trust. Trust that your paycheck will clear, your bank will be there tomorrow, your savings mean something, the rules won't suddenly change. When trust exists, people plan. When trust fades, people freeze. Across America, trust is fading. Quietly. Banks used to be boring. That was the point. They were supposed to feel solid, predictable, invisible to feel. Now many Americans watch banking headlines with unease. Bank failures, emergency interventions, weekend rescues. Even when deposits are protected, the psychological damage remains. People start asking, what if this happens again? What if this happens again? What if next time is worse? Fear doesn't need facts, it needs memory. Individuals absorb the shock. When crises hit, bailouts stabilize systems, households tighten belts, savings disappear, debt remains. Over time, people internalize a belief. If something breaks, I'm on my own. That belief changes everything. Savings used to represent security. Now they feel fragile. Inflation eroded purchasing power. Low returns discouraged patience. Unexpected costs wiped balances quickly. Many Americans say their savings don't last as long as they expected. Runners, they rebuild slowly, if at all. One emergency resets years of effort. This creates a dangerous mindset. Why save if it disappears anyway? And when saving feels pointless, preparedness collapses. Retirement is built on trust. Trust that markets will grow. Trust systems will hold. Time will help. But time now feels uncertain. Millions of Americans report fear they will outlive their savings. Doubt that retirement systems will support them. Expectation of working longer than planned. Retirement stopped being a milestone. It became a gamble. And people don't prepare confidently for gambles. Another problem deepens mistrust. Complexity. Financial systems became harder to understand. Terms like interest rate hikes, liquidity, market volatility, liquidity, monetary tightening. People hear explanations, but don't feel relief. They feel excluded. When systems are opaque, people assume the worst. A system without trust becomes unstable. People hoard. They withdraw. They stop planning long term. Confidence disappears. Fear spreads. And fear doesn't cause collapse instantly. It causes hesitation. Hesitation slows economies. It amplifies shocks. It deepens downturns. This is how fragility turns systemic. Look closely, and you can see it already. Proturo people delaying major purchases. Households holding cash, just in case. Workers afraid to change jobs. Families postponing life decisions. This is not optimism. It's caution. Widespread caution is a warning sign. At this point, the picture is clear. Costs are high. Debt is heavy. Runar income is unstable. Trust is thin. What remains is the human cost. Because financial pressure does not stay in spreadsheets.
Financial stress is not a moment, it's a condition. It follows people to work, home into sleep, finden into sleep, and bloom into relationships. It doesn't announce itself loudly. It whispers, be careful, don't mess this up, you can't afford mistakes. When stress becomes constant, it stops motivating, it erodes. Long-term financial anxiety shows up physically across the country. Research consistently links money stress to poor sleep, high blood pressure, anxiety, and depression, weakened immune response. People don't say, my finances are hurting my health. They say, I'm tired all the time. I can't focus. I'm always on edge. Stress becomes the background noise of life. Money arguments are rarely about numbers. They're about fear. Who's responsible? What happens if something goes wrong? Who carries the risk? Financial stress is one of the leading causes of relationship conflict, breakups, divorce, testimony, partner in a dual income household. We don't fight about vacations. We fight about what happens if one of us loses our job. Love doesn't disappear. Safety does. For parents, money stress multiplies. It's no longer just, will I be okay? It becomes, will my children be okay? Parents report anxiety about food. Education costs, running filskanar averet, education kiler ibline, to parich durate. Testimony, parent of two. I don't worry about today. I worry about 10 years from now. That kind of worry never rests. One of the most damaging effects of financial stress is silence. People don't talk about it, they hide it. Because money problems feel personal even when they are widespread. People think everyone else must be doing better. They're not, but shame isolates, and isolation deepens stress. Under prolonged pressure, people adapt, not always in healthy ways. They avoid long-term commitments, shop dreaming big, choose certainty over fulfillment, accept conditions they shouldn't, risk-taking drops, innovation slows, hope narrows. This is how stress reshapes a society. Quietly, one of the most dangerous shifts is normalization. People say this is just how it is now. Constant hustle, constant worry, constant adjustment. Exhaustion becomes identity, but exhaustion is not sustainable. It only feels normal until something breaks. Financial stress doesn't stay personal. It affects civic engagement, trust in institutions, social cohesion, willingness to plan for the future. A stressed population becomes cautious, divided, reactive. This changes how a country moves.
For many Americans, this doesn't feel like a warning anymore. It feels like now. The squeeze is already here. People aren't asking, what if things get worse? They're asking, how much tighter can this get? That shift matters because it changes how people live. Life has become a series of quiet calculations every month. Can we afford this repair or wait? Do we pay this bill now or float it? Do we go to the doctor or see if it passes? These are not financial strategies, they are stress responses. When survival decisions become routine, people stop feeling secure even when nothing is wrong. One of the clearest signs of financial strain is time, not hours, vision. People used to plan 5 years out, 10 years out. Now many plan 1 month, one paycheck. Long-term thinking feels unrealistic. Testimony, mid-career worker, I don't think about where I'll be in 10 years. I think about whether next quarter will be okay. That's not laziness, that's compression. Under pressure, people delay, not because they want to, because risk feels unacceptable. Across the country, people are postponing, buying homes, having children, changing careers, starting businesses. These aren't luxuries, they're life milestones. When milestones stall, a society slows. Working, smiling, internally, worried, counting, bracing. Testimony of a young professional. I look fine, but one bad month would change everything. That split is exhausting, and exhaustion accumulates. One of the most damaging effects of this moment is comparison. People see social media, headlines, appearances of success, and they think, why am I still struggling? But struggle is widespread. It's just hidden. Because everyone is trying to look okay while feeling unprepared. People adapt in ways that don't show up in statistics. They exclude lower expectations, accept instability, redefine enough downward. This adaptation keeps systems running, but it also masks warning signs because adaptation looks like resilience until it runs out. Every adaptation comes with a cost. Less rest, less joy, less risk-taking, less optimism. People don't collapse. They contract.
That contraction is subtle, but it shapes the future. Cherbaus Amantabe, the Nike Sopra Sutra Notenwing, not through votes, through behavior. Do people pull inward, stop trusting, avoid planning, or do they begin to understand what's happening? Understanding doesn't fix everything, but it changes how pressure is interpreted, and interpretation shapes response. The greatest danger right now is familiarity. People say, this is just how things are. That sentence has appeared before in history, right before major shifts, because when pressure feels normal, systems stop adjusting. At this point, nothing here should feel abstract. This is daily life for millions. So the final question remains, what separates people who endure this period from those who are overwhelmed by it? In part 10, we'll close the circle, not with optimism, not with fear, but with clarity about awareness, preparedness, and what history suggests matters most when pressure doesn't disappear.
The final question, awareness, readiness, and what comes after. This is where many documentaries try to predict the future. They offer timelines, scenarios, certainty, but history doesn't reward prediction. It rewards awareness, because the future is rarely shaped by what people expect. It's shaped by what they notice in time. Readiness is often misunderstood. It's not wealth. It's not perfection. It's not control. Readiness is understanding the environment you're in, knowing pressure exists. Volatility is normal, stability is conditional, and adjusting expectations accordingly. Unready societies cling to old assumptions. Ready ones update them. Every period of prolonged stress produces the same error. People wait for relief. They wait for prices to go back, security to return, normal to reappear. But history shows normal rarely comes back unchanged. It evolves, and those who struggle most are not the least intelligent. They are the most attached to outdated expectations. Awareness doesn't solve problems, but it changes behavior. It replaces confusion with context. It replaces shame with understanding. It replaces panic with preparation. People who understand pressure make fewer impulsive decisions. Recognize risk earlier. Adjust before options disappear. Awareness buys time. Time is the most valuable asset under stress. Right now, many Americans are enduring. They are strong. They are capable. They are tired. Endurance keeps people alive, but agency keeps them adaptable. Agency begins when people stop asking, why is this happening to me, and start asking, what kind of environment am I living in? That shift is subtle and powerful. History does not reward denial. It does not reward panic. It rewards those who accept reality early, adjust behavior gradually, preserve flexibility, protect margin where possible. Not heroes, not geniuses. People who stay mentally aligned with reality. Every economic period ends, but it leaves marks. Some people emerge more cautious, some more resilient, some more divided. The difference is not luck, it's understanding. Understanding doesn't eliminate hardship. It reduces surprise. So the question is no longer, is something wrong? That question has been answered. The real question is, when pressure became the norm, did you notice? And did you adjust your expectations accordingly? Because readiness is not about fear, it's about alignment. If this video made you uncomfortable, that's not a flaw. Discomfort is often the first signal that perception is catching up to reality. And perception matters, because people who understand the moment they're living in are less likely to be crushed by it. Most Americans were not prepared for the world that quietly emerged, but awareness is still possible. And awareness is where readiness begins.